Strengthening bank oversight, Federal Reserve's call for stricter rules. In a testimony before Congress on Tuesday, the Federal Reserve's top regulatory official expressed the central bank's intention to impose stricter rules on banks with assets over $100 billion. Fed Vice Chair for Supervision Michael Barr emphasized the need for supervisors to adopt a more vigilant approach in monitoring and policing lenders, especially in light of recent bank failures. Barr highlighted the agency's careful consideration of rule changes for larger regional banks, which would include factors such as accounting for unrealized losses on their balance sheets when assessing capital levels. These banks had previously benefited from relaxed rules under the Trump administration, but the Fed is now aiming to address potential vulnerabilities more effectively. The failures of Silicon Valley Bank and Signature Bank had a ripple effect on global banking shares, sparking concerns of contagion and prompting intense scrutiny of bank watchdogs. The House Financial Services Committee also heard testimonies from officials representing the Federal Deposit Insurance Corporation, FDIC, and the Office of the Comptroller of the Currency, who expressed their commitment to a more robust supervisory approach. Post-mortem reports on the bank failures revealed that while the regulatory bodies were aware of certain issues, they did not act promptly enough to resolve them. FDIC Chairman Martin Gruenberg acknowledged the core issue as a failure of examiners to enforce compliance when identified issues surfaced. This acknowledgement underscores the need for a proactive and assertive stance by regulators. During the hearing, some Republican committee members advocated for the more efficient utilization of existing tools rather than introducing new regulations. Representative Patrick McHenry, chair of the panel, criticized the agencies for using the crisis as an opportunity to justify the progressive agenda of increasing capital requirements and imposing additional regulations on banks. Representative Blaine Luetkemeyer echoed this sentiment, emphasizing that enhanced supervision would be more effective than simply raising capital requirements. The hearing marked the regulator's first appearance before Congress since the FDIC's sale of failed First Republic Bank to JPMorgan Chase and Company. While committing to draft stricter rules, the agencies have faced criticism for their failure to identify and address weaknesses before the bank's collapse. Simultaneously, former Silicon Valley Bank CEO Greg Becker testified before a separate panel, attributing the unprecedented bank run that led to the firm's demise to rapid interest rate increases and social media-driven rumors. The regulator's testimony underscores the pressing need for a comprehensive and proactive approach to bank oversight, striking a balance between stricter rules, efficient utilization of existing tools, and improved supervision. Thanks for watching. God Kuber bless you with fame and wealth.